What is up, ladder climbers? Antoine Wade here from Elevate to the Unknown and NextGenHeights.com. And the Wade Report, and it is Friday, January the 16th, 2026, 7:26 a.m. And Wells Fargo. The Wells Fargo analyst just said 4 words that should wake you guys up. He said this: the animal spirits have been unleashed. He said competition among the banks is now at its most intense level since before the global financial crisis. Most intense since 2007. I want you guys to type animal spirits if you feel that energy. Here's the thing, okay? Here's what's got everybody talking. Goldman Sachs yesterday, stock hit an all-time high, above $955. All-time high, up more than 60% in the last 12 months. And their CEO, David Solomon, said this. He said basically, the 2021 levels will be exceeded again. They might be exceeded in 2026. 2021 was an all-time peak for deal making, which is mergers and acquisitions. Solomon just said that we might beat that this year. Now, here's the thing. Same week that Goldman Sachs hits all-time highs, the same week that Solomon says animal spirits are back, banks are still cutting thousands of jobs. Amazon's $475 million investment in Saks Fifth, presumptively worthless. That's their words. You guys saw the article outside on Business Insider yesterday. They basically said that investment in the Saks Fifth, since they're going bankrupt, is worthless. That's their words. So you got the same economy. You got the same week. You get opposite outcomes. That is the great bifurcation. The winners are winning big. The losers are losing faster. And the middle is disappearing. I want you guys to type bifurcation if you see it happening in your industry. Type it in the chat. Let's see who's all in the chat today. We got the Life of Cam in here. You got Crypto Cakes in here. You got Big Suggs in the house. You got Sandra Sadao in the house. Good to see you guys. I see the chat already jumping already this morning. It's a fantastic day. It's a fantastic Friday. I am excited about the weekend. Lots going on. But let's not talk about the weekend. Let's get into the data, guys, because we're going to be talking about the bifurcation, and that's a corporate word. But I kind of like the word. It means to split between two. And that's what this show is going to be about. You know, we talked about the two economies. Well, use another word, bifurcation. Let's use the corporate buzzwords these days. All right, well, let's jump into the first segment of the day. Let me break down what's really happening at Goldman Sachs, okay? Goldman Sachs is absolutely crushing it. They just didn't have a good quarter. They basically have a comeback story, all right? A major comeback story. Business Insider put it this way: Goldman Sachs is acting like Goldman Sachs again. Let me show you the receipts, all right? Here's the receipts, guys. $955 a share. Fourth quarter profit, $4.1 billion. That's some big numbers right there by Goldman. $4.11 billion. That's up 34% from last year. Equity trading revenue, $4.31 billion. That's an all-time Wall Street record. All-time record. Nobody in the history of Wall Street has made more money trading stocks in a single quarter. Okay? Full year profit, $15.5 billion. Deal pipeline, 4-year high. And the stock up more than 60% in 12 months. I want you guys to type Goldman in the chat if those numbers hit you different. I want to go to what the CEO was talking about a couple months ago regarding deal making. I want you guys to see what we are in store for 2026, according to Goldman Sachs CEO David Solomon. This was 5 months ago, guys, and listen to what he's talking about when it comes down to deal making in big business, big enterprise business, big business in general. Check this out. Let me get a refresh on this. Refresh this, buddy.
Leading equity financing shop, and that plays a big role in the overall equity beat. And so, clients were active. I wouldn't say that we'll see the volatility we saw in the early part of the quarter in the next part of the quarter, but clients are active. M&A is picking up. IPOs are picking up. That's actually good for the equity trading business too.
Yeah, I mean, there was outperformance there from you. I guess I was looking at the Morgan Stanley advisory feeds. I mean, you had a very strong quarter, even though, yes, M&A is picking up, but it feels like it was supposed to be more robust at this point.
There's been a narrative, and I've watched and I've listened to it, that M&A wasn't picking up during the course of this year. Announced M&A is up 30% year over year. And we have the leading M&A franchise, and we're benefiting significantly from that. I think you saw in this quarter larger outperformance in our M&A accruals than you'll see in most quarters. But our franchise is in good shape. Clients come to Goldman Sachs for the most significant things. And I think one of the structural things that's changed is CEOs believe we're at a moment in time when you can do big strategic consolidation, that it actually can get through the regulatory process. And so they've gotten much more engaged in those dialogues, and we're seeing that. And so I expect a pretty robust M&A environment in the second half of the year, into early 2026.
Oh, that's interesting, because we kept pounding you every time you were on.
You heard him say it. Second half of the year, a pretty robust M&A strategy. Lots of acquisitions, lots of big acquisitions going to be happening later in the year. But check out what they also released on the earnings yesterday. I know I talked about it and I showed you guys it in the previous slide, but check this out.
Sachs just coming out. Morgan Stanley also releasing quarterly results literally at the same time this morning. Leslie Picker's got the numbers.
Hey, Andrew. Yeah, you've got a twofer here. We'll start with Goldman Sachs. Their fourth quarter results, of course, impacted by that transition to the Apple Card program to JP Morgan. On the bottom line, the Apple Card deal benefited EPS by about 46 cents per share. But even without that, the firm would have beat Wall Street estimates. On the top line, Goldman had a $2.3 billion reduction in net revenue from that Apple Card transition, but offset by a release in reserves there. So Goldman generated $13.45 billion in revenue during 4Q. Global Banking and Markets, that's essentially the Wall Street side of the house, that posted $10.4 billion in revenue, $1 billion higher than estimates, and a 22% jump from last year. That division posted record annual revenue as well. Investment banking fees were 25% higher. That's thanks to completed M&A there, and the firm says its backlog increased, quote, significantly year over year. Equity underwriting came in a bit shy of estimates. Equity trading, however, saw a sizable beat, and fixed income currencies and commodities were higher.
Crazy, huh? Crushing it. Absolutely crushing it. And here's what David Solomon said on the earnings call. He said this: I think the world is set up at the moment to be incredibly constructive in 2026 for merger and acquisition and capital markets activity. Then he said this: the 2021 levels will be exceeded again. They might be exceeded in 2026. So I want you guys to understand what that means. Let me break it down for you. Okay. 2021 was the biggest year for deal making ever. When I'm talking about deal making, I'm talking about companies buying companies. That's what deal making is. Enterprises buying enterprises, companies buying companies, small companies buying companies, big companies buying small companies, all that sort of stuff, right? Companies going public. That's also deal making. People, going public, you're getting access to, shares and all that sort of stuff, right? Money flowing basically everywhere. Solomon just said that we might beat that record this year. And his CFO, Dennis Coleman, backed it up. He said the M&A environment is now very, very different than before. All right. And he says this: because scale matters so much in the business. Corporate CEOs get very front-footed when they see opportunity for growth through mergers and acquisitions. So translation, CEOs want to buy other companies. They got the money to do it, and the government is letting them do it. That means more deals, more fees, more hiring at Goldman, at Morgan Stanley, at the firms that help those deals happen. Now, here's the part that explains why Goldman is winning while others are struggling. Goldman, they got out of the consumer credit. OK, remember Marcus, their consumer banking app, right? It was a disaster. cost them billions of dollars, created chaos inside the company, partners fighting, bad headlines. So they made a decision. They sold the Apple Card partnership to JP Morgan. They got out of the consumer credit business. And here's why that matters right now. You know that 10% credit card rate that President Donald Trump is proposing? Many of you guys probably didn't hear about that. Let me share with you about that piece of it, because Donald Trump is proposing a 10% credit card cap. Check this out.
Well, then they're in violation of the law. Very severe things. No, I want a cap on credit card interest rates because, some of them are 28, almost 30%. And that the people don't know they're paying 30%. The people out there, they're working and they have no idea that they're paying 30%. No way. We're putting a 1-year cap at 10%, and that's it. They know it. They've really abused the public. The credit card companies have totally abused it. I'm not going to let it happen.
You heard him. Many of you guys probably didn't hear about this, but Trump is proposing a 10% credit card cap rate because credit card companies are abusing you. They're abusing me. They're abusing everybody. So Goldman, they didn't have to answer questions about this on their earnings call. And Business Insider said that other CEOs had to address it point blank. What happens if Trump puts a cap on your credit card? How much money are you making for credit card fees? Well, Goldman, they passed that problem to JP Morgan. That's what strategic positioning looks like. They saw a threat coming. They got out of it. Now they are reaping the benefits. I want you guys to type swagger if you think that Goldman made the right call exiting consumer credit. It's a pretty good move. You think about it, it's a pretty good move. I'm like, man, David Solomon, not just being the DJ that he is, because he's an EDM DJ. He's the CEO of a biggest investment company that's out there, and he's absolutely crushing it. Big time records, absolutely crushing it. Now, let me show you how hard it is to get into Goldman. More than 1 million people apply for jobs at Goldman every year, just about. And they applied last year. 1 million people applied to work there. Internship acceptance rate, less than 1%. That is less than 1%. That tells you where people want to be. That tells you which side of the bifurcation has the momentum. Goldman is crushing it. Stock at an all-time high, record trading revenue, deal pipeline at a 4-year high. You heard it on the CNBC call. You heard it on the earnings call. That's what proving returns look like. We talked about prove it. That's what proving it looks like. Now, let me show you where else the winning side is hiring and what it tells you about where the power is shifting, okay? I want you guys to stay with me on this next segment. We're going to be talking about talent, the talent war, guys. There's a talent war that's going on here. I came across a story that was on Business Insider, and it shows you exactly where the power is shifting. So you guys know the company Cisco, big tech company, networking company, enterprise software company. Their chief people officer, her name is Kelly Jones, all right? She runs HR for the whole company. She said something that should tell you everything about this job market that we're in. She says this: AI and machine learning operations positions are really hard to fill at the company. She says really hard. Okay. She said the qualified pool is so small and the demand is so high. And then she said this: everyone is currently hiring for those positions right now. Everyone. Every forward-thinking company needs AI in their products. Every forward-thinking company needs AI in their internal systems. And there ain't enough people who know how to do this. I want you guys to type AI if you see the shortage in your industry. Type AI in the chat, okay? Now, here's the part that blew my mind when I was reading this story. Kelly Jones, she says this. She says, when Cisco has a really strong AI candidate, the chief product officer personally calls them, not the recruiter, not the hiring manager, the chief product officer, one of the top executives at the company. She says, if there's someone we are really strategically trying to hire, we will get them and get him involved. And it ain't just Cisco that's doing this. Citadel is doing this, the hedge fund company. Their CTO personally calls top entry-level candidates. I think we talked about this on this show when I saw it on the Business Insider article. OpenAI, Sam Altman, reportedly calls candidates to convince them to join the company. Meta, Mark Zuckerberg, has hosted top candidates at his home for meals. I think he was one of the ones that brought one of the candidates soup at one point in time. You guys remember that? Give me some soup, Big Suggs. I'll bring you some soup. He hosts people at his home for meals. Now, I want you to think about what that means. When the CEO is calling you, when the chief product officer is calling you, when executives are inviting you to their homes, that tells you where the power is. In AI and machine learning, talent has leverage. Companies are chasing you. In credit cards and back office, the company has leverage over you. You get memos about results. You get warnings about performance. You get cut. Same economy, same job market, opposite dynamics. I want you guys to type leverage if you are in a field where talent has the power. Type leverage in the chat. Okay. Now, Kelly Jones also talked about what makes someone stand out. She said it's not just about your skills. Skills can be learned, which is a good thing, because this is why we talk about you going out there, get your certifications and, signing up for this sort of class and you using tools and all that sort of stuff, because skills can be learned. But she also asked, are you intellectually curious? Are you emotionally agile? Are you someone who brings your team along with you? She says this, we want to know, not only have you done these things, but are you intellectually curious? Are you intellectually and emotionally agile? Are you someone who brings your team along with you? That's the prove it economy, guys. It ain't just about what you know. It's about what you can learn, how you can adapt, and how you can lead. The people getting CEO phone calls, they are proving that they can do all three. Okay? Now, on yesterday, we talked about capital ain't the answer, right? Amazon just proved that I was right. Let's talk about Amazon. Let's talk about Amazon. Yesterday, we talked about Saks Fifth filing for bankruptcy. Many of you guys probably don't remember that, but here, I'll share another video with you on why people say it's happening. And I went to Saks Fifth on yesterday, guys, and I'm gonna give you my perspective after she talks about why it went bankrupt. But let's listen into CNBC investigating why Saks Fifth went bankrupt after the $475 million investment from companies like Amazon and Salesforce. Check this out.
Saks just filed for bankruptcy, but that's not because the luxury consumer isn't spending. Saks' problems have been a long time in the making, and a lot of it was their own doing. While parent company Saks Global is private, which includes Saks Fifth Avenue, Saks South Fifth, Neiman Marcus, and Bergdorf Goodman, we know sales have been down significantly over the past couple of years. Sure, department stores have been on a steady decline overall, and that is a part of the story. But its downfall goes well beyond falling sales and spending shifts in the luxury market. In fact, the luxury sector isn't in peril. Consumer spending is expected to remain strong in 2026, and Bloomingdale's is killing it right now by leaning into experiential retail and having the right type of inventory. And Bain forecasts the luxury category will increase by 4 to 6% annually over the next decade. So let's be clear, Saks' problems are largely self-inflicted. Investors have known for a while that the company was struggling, but it became obvious that a bankruptcy was coming when the company missed a payment to bondholders at the end of last year. That was an interest payment for its 2024 acquisition of Neiman Marcus, a $2.7 billion deal that the company financed primarily with debt, which it hasn't been able to manage. But even before that acquisition, Saks was struggling to pay its existing retail vendors.
Acquired a company, couldn't pay the debt. They had challenges paying their retail vendors, just a company that's just full of chaos. Let me tell you my experience about Saks. I went to Saks yesterday. My wife's birthday is on tomorrow, okay? Do some last minute birthday shopping. Went to San Antonio, went to a Saks. And every time I go to a Saks, let me tell you what I see. Personal experience. And many of you guys can probably this will resonate with. You walk into Saks, and I'm the type of person, I like to get what I want to get, and I like to get out, because the people typically there are a bit older. I'm talking about middle to late age in their career. Okay, they're salespeople. Many of them try to seem like they're pretentious. Many of them have a judgmental attitude. Many of them are fighting to get your attention. And it just doesn't give that good warming feeling when you walk into Saks Fifth, at least the ones that I've gone into. And most of the time, there are people just standing around and they're talking to each other because it doesn't have a lot of foot traffic inside of the store. I can see why it is a company that's failing, because there's not an attraction. And then when you go there and you want something, they typically don't have it. You have to order it, or you have to go someplace else. I went there yesterday to, my wife loves perfume. Well, I love buying my wife perfume. And typically you can only get it from like a Saks and so forth, right? Of course, I went and asked a lady about it. She let me smell it. Man, it smelled good. And I've asked for a bottle of it. How much did it cost? Whatever it was. I know what I was expecting from looking at the website. It's like $430. It's expensive, okay? They didn't have it in stock. Then she suggested a new one, which was a extract of the perfume, which lasts a little bit longer. So I was like, okay, well, I didn't do the research on this one. So I held my phone. She's talking about it. She lets me smell it. It smelled good. And I'm like, okay. So I look at a couple other ones that I had on my phone, because I was like, I got to walk out of here with one. I look at a couple other ones, didn't have it in stock. We can order it for you, Mr. Wade. Didn't have it in stock. We can order it for you, Mr. Wade. Didn't have it in stock. We can order it for you, Mr. Wade. I'm like, what do you guys have in stock? Right. And then I'm looking around, and there's not a lot of people inside the store, but there's a whole bunch of people that's just working. So you got a whole bunch of salespeople that's not closing sales. And it's just not a comfortable place that you want to be inside. There's no attraction inside of a Saks. So I can see why they are absolutely failing. Let me know if that's your experience when you walk into Saks Fifth. Maybe it's a different in a different city for you guys, but I can tell you like this. Anytime I've walked into a Saks, I feel like I need to walk in there with a button-up shirt. Otherwise, they aren't going to pay you attention, okay? And there's times where you don't want to wear a button-up shirt. You just want to walk through a mall, get your wife some perfume, and get out of there. That's my experience with Saks. Let her continue, though.
When the acquisition happened, a variety of new investors, from Amazon to Salesforce, flooded the company with fresh capital that, in theory, should have helped clean up its balance sheet.
Should have.
Instead, Saks kept struggling. It didn't pull off the turnaround investors had been promised, and it lost key suppliers when it kept paying its bills late, or not at all. That meant it didn't have the inventory shoppers were looking for, which led sales to drop even further. When it came close to filing for bankruptcy, Saks even had a tough time finding investors.
Listen to that. It didn't have the inventory that customers were looking for. No wonder when I went there, they didn't have the stuff that I wanted. You're missing sales. Yes, I did buy something yesterday. I bought something yesterday, guys. I'm not going to lie. I bought something because I had to. But did I get the thing that I wanted initially from my reviews? No, it wasn't. Did I get something that was probably better? Yes, I did. I have to do reviews on it. She's going to love it. But they just didn't have the inventory. Okay? And that's the challenge that Saks is facing. I told you guys, capital ain't the answer. $2.7 billion in backing by Amazon partnership. Neiman Marcus acquisition. Still filed for bankruptcy. I said a bad business model can't be saved by money. Well, Amazon just confirmed it. In a court filing on yesterday, Amazon's lawyers said their $475 million investment into Saks is presumptively worthless. Worthless. That's their words. That's how they put it. That's what Business Insider wrote an article on it. Here's what they said happened. They said the equity investment is now presumptively worthless after Saks continuously failed to meet its budgets, burnt through hundreds of millions of dollars in less than a year, and ran up additional hundreds of millions of dollars in unpaid invoices owed to its retail partners. Let me break that down. $475 million invested, burned through it in less than a year. Less than a year. Plus, they racked up hundreds of millions of dollars and more unpaid bills. Now, Amazon is asking the judge to eject Sachs' bankruptcy financing plan. They're warning. They're warning them that this could get out of hand. Okay? There's also more drastic remedies that they're saying. So that can be meaning appointing an examiner or a trustee, someone to come in and take over the company. I want you guys to type capital in the chat if you see this pattern at the company that you work for. Companies injecting capital, but the business model is still messed up and there's nothing that you can do about it because they got the wrong leadership there. Now, here's why this happens for or why this even matters for your career, why we're even talking about it, because money doesn't fix broken business models. If your company has a bad business model, if your company is burning through cash, if your company can't figure out how to make money and how to make more money, no investor is going to save it. No partnership is going to save it. No amount of capital is going to save it. Amazon is one of the biggest companies in the world. They invested $475 million. You would think that that's a lot. They have a massive retail leadership team. They know how retail works. It didn't matter. Bad model, bad outcome. The question that you got to ask yourself is your company on the winning side of the model? Or are you riding capital that's going to run out? Because when it runs out fast. And you saw Neiman Marcus 2024, or Saks Fifth acquire all these companies in 2024, and in 2 years, bankrupt. And let me show you why Goldman is protected from the biggest threat in banking and why other banks are massively exposed. Check this out, guys. And I know I talked about it before, but I want to dig into it a little bit more so that you guys have a better understanding of it, okay? Let me show you something that explains the whole bifurcation. President Trump, you guys saw in the video, proposed a 10% cap on credit card interest rates. Right now, the average credit card rate is over 20%. Some cards charge 30% or more. Trump wants to cap it at 10% for 1 year. Now, here's the thing. If you got a credit card and you got credit card debt, that sounds great. But if you work at a bank, this could change everything. Let me show you the numbers here, okay? Let me show you the numbers. U.S. credit card debt, $1.13 trillion. Bank revenue at risk, if cap passes, $40 to $60 billion a year. That's why bank CEOs are nervous at this point in time. Jamie Dimon at JP Morgan, he warned that a 10% cap would adversely affect consumers, reduce credit access. Jane Fraser at Citi, that's why she sent the memo. We are judged on results. You guys remember us talking about that on yesterday. She knows credit card revenue is at risk. She needs everybody proving their worth. But here's the thing. Goldman Sachs, they don't have to worry about this. Why? Because they got out of that business. They sold the Apple Card partnership to JP Morgan. They exited consumer credit. So when analysts asked about the credit card cap on Goldman's earnings call, they didn't have to answer. Business Insider said other CEOs had to address it point blank. Goldman, they passed that problem to somebody else. I want you guys to type smart in the chat if you think Goldman played it just right. Now let me show you the framework. I call it protected versus exposed. Protected banks, little or no credit card exposure. Goldman Sachs, the exited consumer credit. Morgan Stanley, focus on wealth management, fee-based revenue. Regional banks like PNC, focus on commercial lending. Business customers, no credit cards. Boutique investment banks, Evercore, Lazard, Motelis, they do deals, no credit cards at all. Okay? Now, exposed banks, significant credit card revenue. JP Morgan, largest credit card issuer in the country, just took on Apple's or just took on Goldman's Apple Card. Citigroup, heavy credit card reliance. That's why Fraser is cutting 23,000 jobs. Okay? We talked about that on yesterday. Bank of America, big credit card portfolio. Capital One, pure play credit card company. If this cap passes, Their entire business model is threatened. You're talking about Discover. You're talking about Synchrony. Same thing. I want you guys to type protected if you work at one of these companies. Type exposed if you work at an exposed company. I want to see where you guys are at. Okay. Now here's why, and here's what this means for your career. If you are in credit cards at any bank, start networking out this week. Okay. Even if the caps doesn't pass, the uncertainty is already causing banks to pull back. Hiring freezes, strategic reviews. If you are at Capital One, Discover, Synchrony, pure play credit card companies, your entire business model depends on charging high interest rates. If that goes away, everything changes. The smart move is to position yourself now, not to wait to see what happens. Goldman saw this coming. They got out early. The question is are you going to wait until it's too late? Or are you going to be positioning yourself while you still can? Here's the thing. If you want to know exactly how to position yourself, how to audit your last 90 days, how to build an AI portfolio, how to move from exposed to protected, check out our Patreon, www.patreon.com/Black Heights. We got documentation templates. We got positioning frameworks. We have weekly strategy calls at Saturday at 7 a.m. in the morning with me, the life of Cam, the lieutenant. Okay, link in the description of this video, of this broadcast. Now, I want to show you guys something. Okay? I like to talk about careers and outcomes and career pivots. Let's talk about two people who made career pivots this year. Same situation, but opposite outcomes, and what it teaches you about making moves, okay? Stay with me on this next segment. This segment is about two real people. Came across their articles on Business Insider as well. Both made career pivots. Both felt stuck in their career. Both made moves. But one worked out and one didn't. Let me tell you what the difference was and what made the difference. First, let's talk about Jocelyn, 30 years old. Okay. Data engineer at Google. Making six figures. All right. From the outside, perfectly dream job. But she said she felt unseen at a company that was that big. She felt like her work didn't make any of an impact. Okay. Then January 2023 happened. Google announced that they were laying off 12,000 people. She said it was crazy. It was a scary time. So she started thinking, what do I really want to do? And she remembered something. When she was at BYU, because she went to Brigham Young University, she taught programming classes. She loved it. She was good at it. So she made a decision. She left Google to pursue a PhD in computer science education at the University of Illinois in Illini. Okay. Now she took a big pay cut going from Google to teaching, right? But she's getting the six figures to going from six figures to basically a graduate stipend. But here's the thing. She got 3 years of funding from the university. She's pursuing something aligned with her passion. She got a clear goal. Help more people get into computer science, she said. And she says this is her quote. If I don't do it now, I'll always be wondering, what if I had? That's someone who ran to something that she wanted to do. That's someone who said I was going to get it done. Someone who took a risk. Now let's talk about Justine. Justine, 27 years old, PR professional. She was burnt out, didn't like her clients, felt stagnant. Okay. So she made a move. She left PR to become a high school English teacher, took a 36% pay cut, and she quit after one semester. Here's what she said. I switched careers because I was dissatisfied with my original place of work. She called it running away from the discontent rather than working through it. She said she didn't have a clear goal. She just wanted to escape. And when the new job got hard, she had nothing to hold on to. Now, she says, I ain't here to judge my situation anymore. But here's a situation that I'm going to talk about for both of these girls, or these ladies. Career pivots are hard. They're just hard, man. Both of them had the courage to make a move, which is a good thing and something that I would applaud at. But here's the lesson. Jocelyn ran to something that she had a passion for, that she really wanted to do. She had a clear destination. She had a funding plan. She had skills that aligned with her passion. She, was working as a data engineer at Google. She already had computer science in her background. She went to go teach computer science because she loved it when she was in college. Justine, she just ran from something to escape the discomfort. She didn't have a strategy. She didn't have no clear goal. She was just basically saying, I'm running away. In the prove-it economy, running from is not the strategy. Running to with a plan, that's the positioning. I want you guys to type plan in the chat if you're running to something, not just running from something. Type plan in the chat, okay? If you are feeling stuck, if you are thinking about making a move, you probably should pause and ask yourself, am I running to something or just running from something? If you don't have a clear destination, then you got to build one first. The move will still be there when you are ready, but you'll be ready to actually succeed. Okay. Now, let me give you the decision framework. 3 questions that tell you what to do next if you're going to be making a move like this. All right. Stay with me on this segment. Okay. Here's a framework. 3 questions. Pretty simple. And I want you guys to answer these honestly. You answer these honestly, you'll know what to do next. Question 1, is your company protected or exposed? Protected companies, Goldman Sachs, Morgan Stanley, TSMC, who we talked about on yesterday, NVIDIA, Cisco, regional banks focused on commercial lending. They are on the winning side of the bifurcation. Exposed companies, credit card divisions, traditional retail, companies burning through cash, companies that can't prove returns. If you're at a protected company, stay and position yourself for growth. If you are an exposed company, start networking out. Question 2, does talent have leverage in your field? AI, machine learning, CEOs are calling candidates. Talent has leverage. Semiconductors, talent shortage of 5,000 to 8,000 engineers a year. Talent has leverage. Investment banking, 4-year deal backlog. Talent has leverage. Credit cards, back office, traditional logistics. Those companies have leverage over you. If talent has leverage in your field, you can negotiate aggressively, document your wins, position yourself for the best opportunities. If companies have leverage over you, you better build skills to flip that dynamic. You better build those AI skills. You better build those data skills. You better get certifications that move you to the other side. Question number 3, are you running to or are you running from something? If you are making a move, make sure you got a clear destination, a clear goal, a funded plan, skills aligned with where you are going. That's running to something. If you are just trying to escape with no clear destination, no strategy, no pain, just trying to get rid of pain, probably should pump the brakes. Think, build your first plan, move when you are ready and you have a clear path. Okay? I want you guys to type move in the chat if you're making a career move this month. Excuse me. Okay? Here's your actions. Let me give you some actions because we're going to give you guys actions on this show. Can't go without giving you guys actions. I told you guys on yesterday that week 3 of January is a peak interview season. Applications this week convert 3 to 4 times better than February. Q1 hiring decisions finalized in February. Budget allocated. Headcount approved. Offers extended. If you are not in the pipeline by the end of January, you are waiting till Q2. So here's your actions. If you are at a protected company and talent has leverage, document your last 90 days. Prepare for bonus negotiations. Position yourself for promotion. If you are at an exposed company, start networking this week. Update your LinkedIn. Reach out to 5 people at protected companies. If you are thinking about a pivot, write down where you are running to, not what you are running from. Build the plan before you actually make the move. If you are in AI or semiconductors, you got leverage. Use it. Don't settle. Now, here's the thing. If you can't catch this show live Monday through Friday, make sure you are subscribed to our newsletter. Every single weekday, Monday through Friday, you get a full recap of everything that we've covered on this show. The data, the stories, the strategies, delivered straight into your inbox. Link it to the description of this video. Okay? Make sure you're subscribed to the newsletter, guys. That's how you can get access to all of this information in your inbox, so you can just read it and you know what went on in the show today. Let me give you guys the executive summary to wrap this thing up. Okay? Let's wrap this thing up. Give me a full recap. 3 takeaways from today. Number 1, animal spirits are back, but not for everybody. You got companies like Goldman hit an all-time high. David Solomon says 2021 levels could be exceeded this year. Wells Fargo analyst says competition is at the most intense since before the financial crisis. The winning side is winning bigger. The losing side is losing faster. The question is which side are you on? Number 2, where talent has leverage. CEOs are calling candidates. Chief People Officer says AI roles are really hard to fill. When they find someone good, the Chief Product Officer personally calls them. Citadel, OpenAI, Meta, same thing. When executives are calling you, that's where the power is. Are you in credit cards? Are you in the back office? You don't get calls from CEOs. You get memos about results. You get Zoom meetings on your calendar with a whole bunch of others and potentially get laid off. All right. Number 3, run to something. Don't run from something. Run to something. You heard about the 2 career pivots. One from Jocelyn. She ran to a PhD in computer science education, 3 years of funding, clear goal. Justine ran from a job that she didn't like. No plan, quit after 1 semester. In a proven economy, escape is not a strategy. Positioning yourself is. All right. Check it again. If you want the Prove It audit, you want the Prove It positioning frameworks, you want weekly strategy calls, check out our Patreon, www.patreon.com/Black Heights. If you are serious about positioning yourself for what's coming, check it out. That's where we go deep. That's where we have the Saturday morning calls. That's where we have the community conversations. Second, if you miss any of this week's shows, the newsletter gives you a full recap of every weekday, Monday through Friday, sent to your inbox at 11:30 a.m. Central. I have it automated. I have automation that basically extracts the transcript from these shows. Okay? Does a full extract on that. Puts it into a morning brew newsletter format, and then sends it out to you. But the only way you get access to it is you subscribe to the newsletter, and it's free. All right? Click on the link in the description of this video to sign up for it. Goldman Sachs, you heard about the data, crushing it. Cisco, talent war. People in AI, machine learning is hard to find. Amazon, Sachs 5th update. They are upset that they invested $475 million and that went nowhere. Man, that's a big investment. All right. All that information will be into the newsletter this morning that goes out at 11:30 a.m. Central. And by the way, if this show has helped you see the market a little bit clearer, hit the like button. If you are not subscribed to this channel yet, make sure you hit the like button. I give this sort of conversations about the business world and how it impacts your career Monday through Friday. All right. Hit the subscribe button. Do it right now. Turn on the notifications so that you are notified when we are live during the weekdays. We're basically here every single weekday in between 7 and 7:25 a.m. Central. Monday, I'm going to have a good show for you guys. We're going to give you guys an update on the federal workforce update. We're going to see who moved over the weekend. We're going to see what was announced by late day today. And we'll come to you guys with that on Monday. But again, hit the like button if you enjoyed this content. Hit the subscribe button. If you are new here and haven't hit the subscribe button yet, share this with someone who needs to see the bifurcation. David Solomon, the EDM DJ. He was under a lot of pressure, guys, at one point in time. David Solomon was under a lot of pressure, man. He was like, nope, he ain't the guy for Goldman. And who would have thunk it? He is absolutely on the moon right now. Check out his little DJ sets. Let me see if I can, well, matter of fact, check this out. All right, you have news like this one right here.
Goldman Sachs CEO David Solomon has hung up his headphones and has stopped DJing, a side hustle he's been enjoying since 2015. His pastime has really come under scrutiny since 2018 when he was named CEO of the bank, and he hasn't spun records at a high-profile event since Lollapalooza of last year.
Look at that. This man was doing some DJing on the side, enjoying himself. And guess what happened? People didn't like it. Now he said he stopped doing a little bit of DJing as a hobby. Now the bank is doing really good. He's going to go back to DJing again. Oh, gosh. Insane. Let's check out the chats. How you guys doing today? Danny, good to see you, man. Life Cam says, have a great weekend, Wayne. I hope to see you tomorrow on tomorrow's Patreon call. Jason says, I miss your closing music from the cartoon. You know what, Jason? Man, I'm not going to be doing any of that closing music anymore because guess what happens? Any music that you have in your shows, YouTube and other content creators can copyright the music. So they split the revenue with you. So no more music in my shows, no more any of that. I stopped that a while ago. Not happening. Antoine, Big Suggs says, thanks, Antoine. Peace, light of climbers. Be safe. Keep grinding. I appreciate it. Wayne, thank you. Sandra says, once again, a great show. I appreciate it. Thank you. Guys, go and enjoy the rest of your Friday. I got to get some work done. We'll catch up, okay? Talk to you later. Bye-bye.